Welcome to the Microcap Brief. In our past episodes, we've navigated the essential survival skills for this market, from NASDAQ compliance battles and the threat of dilution to the stark warnings of a going concern opinion. Today, we shift our focus from survival to growth. Specifically, we're tackling a strategy often presented as a fast track to expansion: mergers and acquisitions, or M&A. Think of a microcap company as a car it's trying to build. Organic growth is like designing and building your own engine, piece by piece. M&A is like buying a pre-built engine from another company and trying to bolt it into your car's frame. When a microcap announces an acquisition, is it adding a turbocharger to an already powerful machine? Or is it trying to duct tape a lawnmower engine onto a broken chassis? Let's break down how to tell the difference. The first and most important question is always, why is this deal happening? This is the blueprint for the entire project. Listen carefully to management's reasoning. Are they buying a specific piece of technology that their car is missing? Are they acquiring a company that gives them access to a whole new dealership network in a profitable region? Be deeply skeptical of deals that are justified only by vague promises of synergy. Synergies are the supposed cost savings or performance boosts from combining two companies. They are notoriously difficult to achieve, especially for a small company with limited resources. The critical question is this: does this new engine make the entire car faster, more efficient, and more valuable? Or is it just making the car heavier? Bigger is not always better. Next, we look at the price tag. How is the company paying for this new engine? This is where our episode on dilution comes roaring back into focus. There are generally three ways. First, with cash. This is rare for microcaps, as they often don't have large cash reserves. If they do use cash, you must ensure it doesn't leave their fuel tank empty, crippling their ability to operate. Second, with stock. This is the most common method and the most dangerous for you. The company issues a massive number of new shares and gives them to the engine seller. This is pure dilution. You are giving away slices of your pizza to pay for the new part. You must ask, is this new engine really worth the smaller slice of the pie I'm left with? And third, with debt. Taking on a large loan to buy another company adds a heavy weight to the car. This new debt can strain the company's finances, potentially breaking the car's suspension and pushing it towards the going concern risks we covered last time. The final and often hardest part is making it fit. The blueprint might look great, and the price might seem right, but now the mechanics have to actually install the new engine. This is where most deals fail. Merging two companies is incredibly complex. Do the bolts line up? Do the electronics from the new engine talk to the car's computer? Does the new engine even run on the same kind of fuel? In business terms, this is integration risk. Company cultures clash, key employees from the acquired company quit, customers get confused and leave. For a small microcap with a tiny management team, the risk of a failed integration is exceptionally high. A bad acquisition can destroy value faster than it was ever created. So why does this matter so much? Because a well-executed acquisition can be transformative. It can be the turbocharger that propels a microcap to a whole new level of growth and profitability. But a poorly planned, overpriced, or badly integrated deal can be catastrophic. It can lead to severe dilution, crippling debt, and a distracted management team that crashes the entire car. Your key takeaway is this: look beyond the initial headline hype of an acquisition. Your job is to be the master mechanic. First, check the blueprint. Does the strategic reason for the deal make sense? Second, examine the price tag. Is the cost in dilution or debt worth the potential reward? And third, assess the team's ability to actually make it fit. Can they handle the integration? Your homework is simple. When you see a microcap announce an acquisition, go straight to the SEC's EDGAR database. Find the 8K filing that details the deal, read it. Calculate the dilution, understand the financing, and ask yourself the hard questions. Be skeptical, be thorough, and always do your own research. Thank you for listening to the Microcap Brief. Join us next time as we continue to equip you with the knowledge you need to make informed decisions. Until then, invest wisely.